If you're looking for the ultimate form of passive income, there is no better option out there than being a dividend investor. And I know you've heard it everywhere before, but what exactly is dividend investing and how do we go about it? That's what we'll be getting into in today's video. Welcome to Financial Market TV. If you're new to the channel and enjoy content like this, hit that subscribe button and the notification bell. Also, please don't hesitate to share your comments down below and give this video a like. Let's get started. A dividend is a payout of a portion of a company's profit to people who own their own stock, aka shareholders. As a result of how it works, a firm may or may not opt to pay a small amount of its revenue to shareholders as a reward for those who own their own shares. It's crucial to understand that not every company pays dividends. Some newer companies like Tesla do not pay dividends to their stockholders. Instead, they'll choose to reinvest all of their revenues back to the business. Dividend payments are placed into shareholders' brokerage accounts, which are accounts that are used to buy and sell stocks. Dividends can be received in cash or reinvested in the same stock to purchase new shares. The majority of dividend stocks pay out to shareholders once every 3 months. However, depending on the business, some businesses may pay monthly, semi-annually, or even annually. If you want to know if a certain stock pays dividends, go to a financial website like finance.yahoo.com and type the company name or the ticker symbol in the top search box. Look for the dividend yield field after that. If a percentage appears, it signifies the stock has paid a dividend in the previous year. Dividend yield is a ratio of how much you're getting for each dollar invested. It's also vital to remember that the larger the dividend yield, the higher the risk involved. When a firm is going through a rough patch, it may decide to lower or remove dividends entirely. So while a continued dividend isn't a guarantee, many corporations have been paying dividends for decades. So now that we've covered the basics, let's dive into the steps in beginning your dividend investing journey. Step 1. Commit to it ASAP. Because the younger you are, the more benefit you will derive from your money's growth and compounding. The dividend's snowball effect is a well-known phenomenon in dividend investing, and it refers to the compounding impact of reinvesting dividends into the same investment to boost future payments. We'll use Realty Income as an example. As a corporation that has given monthly dividends to stockholders for decades, assume you made a $10,000 investment in this stock 25 years ago. You also made the decision to reinvest all of your dividends. Every single one of them, you'd have $271,070 in Realty Income shares and 83 cents in cash. Realty Income began paying monthly dividends to stockholders in January of 1997 at a rate of around 15 cents per share. So in 1997, a $10,000 investment would have purchased you 864 shares and paid you around $129 per month in dividends. However, because you elected to reinvest all of your payments in buying additional shares today, over the last 25 years, you now own 3,785 shares of Realty Income. And since it now pays about 24 cents per share because they've continued to grow, instead of making $125 a month, you'd now be receiving $908 a month. And that's just assuming you invested $10,000 into this stock just one time, and you never bought any more shares with the exception of using the money you received in dividends to buy more shares. So knowing this, you can understand why it's really important to get started in dividend investing as early as you possibly can. Step 2. Set up a brokerage account. When people ask me what brokerage platform I prefer, I usually tell them they have 2 options. You can use one of the more established businesses such as Fidelity, Charles Schwab, or one of the newer platforms like Robinhood, Webull, Moomoo, to name a few. Another thing I've read is that these newer platforms may impose limitations on the types of investments you can purchase. So I've heard that from newer platforms, they won't let you trade certain types of holdings if the platform considers them to be too dangerous. One of these types of investments is covered call funds. And while I understand these platforms want to protect less sophisticated investors, I also believe they should give people the freedom to invest in whatever they want. When you're creating an account, you'll be presented with 2 options. You have the option to open a retirement or non-retirement account. There are 2 types of retirement accounts. A regular IRA is one type, while a Roth IRA is another. If you perform a Google search for Roth versus conventional, you'll find a lot of information. You'll also discover some interesting articles that discuss the advantages and disadvantages of each. Setting up both a non-retirement and a retirement account is something I'd encourage. However, the majority of your investing will be based on your goals and preferences, as both retirement and non-retirement accounts offer their own set of advantages. In a non-retirement brokerage account, for example, you have the freedom to invest as much as you wish. You can take out as much money as you want and purchase and sell equities whenever you want. However, the amount of money you can put into a retirement account each year is limited. You can only invest up to $6,000 every year, or $7,000 at the time of this video's production. Retirement accounts also don't enable you to take your investment returns until you're 59 and a half years old, if you're over 50. On the plus side, you'll pay a lot less in taxes if you invest in a retirement account. So for example, in a Roth IRA, you'll never have to pay taxes on your dividend income. You'll also won't have to be concerned about capital gains taxes. Obviously, this will save you a lot of money if you can amass a sufficient amount of money in a retirement account. To summarize, this is what I would advise. If you despise paying taxes, I propose putting the majority of your money into a retirement account. If you want to retire early and expect to contribute more than $6,000 a year and you don't mind paying more in taxes, a non-retirement is the way to go. If you don't live in the United States, you'll need to seek up what kind of brokerage accounts are available in your nation. Once you've created a brokerage account, just add more money to it by connecting your bank account and transferring money in. Step 3. Choosing your dividend strategy. There are two options, which is a dividend growth strategy or an income strategy, or a lot of people will use a mixture of both. Dividend growth investing is when someone buys in stocks and ETFs with lower dividend yields, often between 1 and 3%, and waits for the stock's dividend payout amounts to grow over time. J&J, Microsoft, Procter & Gamble are some of the most well-known dividend growth stocks. These firms have lower dividend yields, but they have been able to increase their payouts in the past, usually on a yearly basis. Income investing is the practice of buying stocks and ETFs with high dividend yields but little long-term growth. Income stocks and ETFs like the ones we just looked at will offer investors dividend yields ranging from 6 to 12%. A notable example in an income stock is Ares Capital, which has a dividend yield of approximately 8%. New Residential Investment Corporation has a market cap of approximately 9%. Then there are covered call exchange-traded funds such as these, which have dividend yields of about 12%. Now, as far as investment approach, which one is the best, that is entirely a matter of personal opinion. The majority of people in their 20s and 30s are advised to invest in dividend growth stocks. In your 50s, 60s, 70s, though, you want to concentrate on income investment. If you're younger, seeing significant dividend distributions in your account drives you to save and invest more money. I actually advise you to pursue income investing while keeping a portion of your portfolio dedicated to development. Don't let anyone convince you that concentrating on income investment is a bad idea. If you enjoy it and it encourages you, go for it. You will, however, have to pay extra in taxes. It's easier to predict how much in dividends you'll need to replace your income if you do it in a non-retirement account if you're seeking to retire early on passive income. Just make sure you diversify your stock portfolio, which is another critical risk reduction technique. Another advantage of being a dividend investor is that when the stock market drops, it's a good news for us, while it's bad news for growth investors. When the stock share price of a strong, reputable company declines, it really presents a terrific buying opportunity when you contribute more and reinvest dividends. You'll be able to acquire more shares of your preferred stocks because they'll be at a discount. And because you buy more shares, you'll get more dividends, allowing you to accelerate the growth of your snowball. So, as Warren Buffett puts it, be scared when others are greedy and be greedy when others are scared. Once you've determined which strategy you want to pursue, keep this in mind. Step 4. Build your portfolio. If you're looking for dividend stocks, I believe YouTube is one of the best venues available to learn. You may also run a Google search for dividend or income stocks, which will bring you a slew of information from a variety of sources. If you locate a stock you like, make sure you examine both the positive and the negative aspects of it. When it comes to valuing a dividend stock, there are a few things to consider. You should learn how to read a stock's financial statement if something that you're interested in is there. Make certain that you understand how to interpret a company's income statement, balance sheet, and statement of cash flows. If you don't want to do it, then don't do it. I'd recommend investing in a diversified dividend ETF if you want to take a more passive approach to dividend investing. Everyone has an opinion on how many stocks and ETFs you should have in your portfolio, and it all relies on your investing strategy. However, some believe that more than 20 or 25 companies are definitely too numerous, as monitoring the success of that many companies will be time-consuming. It's a good idea to strive for at least 10 to 15 stocks, but a bit more wouldn't hurt. Once you've created your portfolio, you're ready to start. If you want to grow your dividend income as quickly as possible, remember to reinvest all of your dividends unless you happen to have enough money invested already to live off of those dividend holdings. And that's it for today. Thanks for watching the whole video. Again, if you're new and like this type of content, subscribe to our channel. And don't forget to leave a comment down below and hit that like button. Also, click on the notification bell to get updated on our weekly uploads. See you in the next video!